The single most critical number you need to understand and internalize right now is 40. That's exactly the current Shiller price-to-earnings ratio, a powerful valuation metric that reveals just how overstretched market prices have become. As of early 2026, stock markets are trading at valuation levels that have only appeared once before in recorded history, precisely during the peak of the dot-com bubble when irrational exuberance drove prices to unsustainable heights. The last time the Shiller P/E ratio reached this extreme territory, the Nasdaq Composite lost nearly 80% of its value from peak to trough, erasing years of gains, while the broader market was pulled into a brutal, multi-year reset that devastated investor portfolios across the board. What elevates the danger of this moment beyond just sky-high valuations is the surrounding context. In 2008, the global economy grappled with one primary dominant shock stemming from the subprime mortgage meltdown and housing collapse. Today, however, we face multiple structural failures materializing simultaneously across key sectors of the economy. This scenario isn't a straightforward repeat of the 2008 financial crisis. It represents a far more intricate and interconnected system buckling under significantly greater overall strain. The majority of economic forecasts fail to capture this precarious reality. Prominent large financial institutions persist in forecasting moderate economic growth alongside minimal recession risk heading into 2026. While their projections of steady progress may sound comforting and reassuring, a review of historical patterns demands a healthy dose of skepticism and caution. These are precisely the same institutions that repeatedly underestimated and dismissed mounting risks in the lead-up to every major downturn of the past several decades. Traditional financial models perform effectively in environments where systems operate within normal parameters and historical precedents hold. They break down irreparably. However, when numerous interdependent systems fracture and fail in unison, creating cascading effects no model anticipates. To grasp why 2026 presents such an unusually elevated level of risk, one must closely analyze the four distinct stress points now converging at the same moment. Crucially, every one of these pressures is grounded in concrete, quantifiable data rather than abstract theory. The first major pressure point centers on commercial real estate, where over $900 billion in commercial property debt comes due for maturity in 2026 alone. This follows more than $500 billion that matured in the prior year, creating an enormous wave of refinancing needs. These massive loans were originated during a prolonged period of ultra-low interest rates, making borrowing extraordinarily cheap at the time. Refinancing them today demands interest rates approximately double those original levels, dramatically increasing costs for borrowers across the sector. This refinancing hurdle might prove manageable on its own if commercial property values had stayed firm, but they have not. Office vacancy rates throughout the United States have skyrocketed to unprecedented highs, propelled by the enduring shift to remote work that continues to reshape and suppress demand for traditional office spaces. In numerous major cities, vacancy rates now hover at or surpass 30%, according to recent data. This toxic combination forges a lethal equation: skyrocketing interest costs for refinancing, plummeting asset values, and a sharp decline in willing buyers, squeezing owners from every angle. When property owners cannot successfully refinance, cannot offload properties at reasonable prices, and cannot service their escalating debt payments, defaults become unavoidable. Delinquency rates in commercial mortgage-backed securities are already surging. For example, in December 2025, KBRA-rated U.S. private label CMBS delinquencies stood at 7.7%, while the distress rate reached 10.6% and continues to climb rapidly. Hundreds of regional banks maintain heavy, concentrated positions in these vulnerable commercial real estate assets. In 2008, residential mortgages served as the critical weak link igniting the crisis. This time, commercial property occupies that role. A J.P. Morgan private bank report notes small banks hold 4.4 times more exposure to U.S. CRE loans than larger peers, while Citigroup analysis shows banks comprise 54% of the $5.7 trillion CRE market, with small lenders holding 70% of CRE loans. The core mechanism propelling this brewing trouble remains identical to past crises. The key change is simply the asset class now at the epicenter of the vulnerability.